This is a market that's all hawked up, that is prepared for hawkish central banks, even if many economists aren't.
I think that's right. And if you look at what markets are pricing in, I mean, markets are pricing in, very significant tightening cycles. In the case of the RBNZ, as they said, kind of a stitch in time saves 9. If they do more now, that may mean that they do less later on. So, they went 50 basis points. They may well go 50 basis points at the next meeting to get ahead of this. But it doesn't necessarily mean that you should move up your higher end, terminal rate expectations.
Is there a degree to which then, Andrew, that the market has just gone too far?
Well, I think it depends where you look. I think in Europe, so closer to home here, the market's pricing quite a lot for the ECB. It's difficult to compare with the past cycle because we had a European sovereign crisis in the past, but the market's pricing in, pretty restrictive stance, I would say, over time for the European Central Bank. If you compare it with the US, yes, you're having some overshooting versus neutral rates, depending on your neutral rate forecast for the Fed. So some tightening there, but I think that could definitely go further in the US. And when you look at underlying inflation in Europe, the headline number is certainly high. The core inflation number is nowhere near as high as in the US. So much more of an energy story in Europe. So I think it depends where you look. I think it's plausible to think that the markets could price in more for the US over time. Europe, you've priced in a lot. For the RMBs and RMBNZ or Australia looks pretty reasonable. And then the UK is interesting because more than some of the other central banks, the Bank of England has looked at the growth implications as well as the implications for inflation coming out of the Ukraine conflict.
If I can just focus us in on the U.S. for a moment. And by the way, I've been getting a lot of flack for saying RBNZ today, so at least you're saying Zed. When you look at the U.S., Bullard wrote an opinion piece in the FT saying that it's a bit of a fantasy in current central bank policy that just getting to neutral isn't putting enough downward pressure on inflation. It's just ceasing to put upward pressure on inflation. At what point do rate rises, does the overnight benchmark borrowing cost actually start to rein in inflation?
Well, so I think that's right, that given where inflation is, given the tightness of the labor market, the Fed is going to need to slow the economy. So the Fed is going to need to go above neutral. The Fed, I think, has about 2.5% for their assumption for neutral rates. We're probably a bit below that, but it seems perfectly plausible to think that 100 basis points or so above the neutral rate would be not such a big call. And then you need to look at overall financial conditions as well. The policy rate is important, chiefly in terms of the impact on longer-term rates, credit spreads, and overall financial conditions. So as I said, I think you can price in some more tightening in the US. In the funds I manage, we're positioned for that. And outright tightness. Okay. But then you do have to think there's a lot of tightening priced in for this year, and so you do need to look at the impact on growth further down the line. The shape of the yield curve gives you that indication as well. So it's a tricky path between the Fed doing what it needs to do and the risk of slowdown or recession risk in next year, say.